Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menasce. This is the weekend edition where we interview notable people from the world of real estate investing. Today is no exception. We have a great guest all the way from Milwaukee. Welcome to the show, Eric Brunner.
Thanks for having me on.
Well, Eric, great to have you here. Excited to have this conversation, and I know for some people talking about tax is not always the most exciting thing, but we've got some interesting things to talk about. Maybe before we do, perhaps give a little bit of your backstory and how you got to this point in your journey.
Sure, absolutely. So I started in Big Four public accounting, worked in Deloitte in the Milwaukee and Chicago markets for about 8 years, and then worked with a lot of high net worth families, family offices, some real estate folks, but I actually was making a proposal to a prospective client that was a family office that had heavy real estate involvement in the Milwaukee area. And they offered me a job. I was the tax director with this group for 3 years, and they have a industrial portfolio all over the country, probably over 100 properties. And that really honed my skills and helped me develop an interest in real estate investing and the tax benefits of investing in real estate, and eventually decided to start my own firm, and with the goal of attracting, similarly situated clients. So we have a small CPA firm here in the Milwaukee area. We have 6 CPAs. One of them is one of my partner and I actually were interns together right out of college and worked together for several years in Big Four accounting. And probably 90% or more of our clients own properties or are invested passively in real estate. So we work with a lot of developers, a lot of landlords, and other people that are in businesses ancillary to real estate.
There's many different aspects to engaging an accounting firm. There's the compliance part and all of that. I'll say it's a little bit mechanical. The value add really comes from developing the right strategy, the right structures, making sure things are categorized properly. And of course, in real estate, the big thing over the last several years, refreshed again last year, is bonus depreciation. But there's other avenues as well that we would look at also. You want to talk a little bit about, especially for those professionals that want to get, they want to get depreciation to offset some of their other active business income.
Right. Yeah, absolutely. The something that's very attractive about investing in real estate is using non-cash deductions through depreciation, amortization of your property to offset your taxable income, your revenue, your rents that you're receiving. And bonus depreciation is a highly popular tool to maximize tax losses. It was expanded, in 2017 by reinstating 100% bonus depreciation. A lot of our clients rely on reinvesting in existing properties and new properties to kind of kick that can down the road when it comes to paying a tax bill. But, there's other ways to take advantage of these large write-offs without capitalizing and depreciating them. Yes, some improvements are eligible for 100% bonus, land improvements, certain interior improvements to commercial properties. But there's a lot of big dollar investments in your property that most folks would think are typically not eligible for bonus. Putting on a new roof, repainting the exterior of a property. A lot of accountants and a lot of taxpayers are going to assume that those projects, just because of the price tag on them, need to be depreciated over 39 years for commercial property, 27 and a half for an apartment building or other residential. But the IRS, through tangible property regs, is pretty clear that unless an improvement, is considered a betterment to the property, it actually takes the existing materials and uses higher grade materials. A restoration of the property, the property was damaged, unexpectedly, and you need to restore it back to its original condition, or an adaptation. You're taking a residential property and turning it into commercial, vice versa, turning a garage into, apartment. Unless the improvement reaches one of those levels, it doesn't need to be capitalized and depreciated.
Let me hit you with an example. So let's imagine for a moment that you've got, I don't know, 25, 30-year-old apartment complex, and you want to repave maybe the access drive and part of the parking lot, maybe not the whole thing in its entirety. It's going to come with a big price tag for sure. I think a lot of folks would naturally assume that given the lifespan of that might be, 15 years, let's say, of that improvement, you're saying that may not necessarily need to be capitalized?
Right, exactly. Most people would, but that parking lot, that driveway, it doesn't have an indefinite life. The products that are used to repave, you buy them just for your home, even at the store. It recommends redoing that every several years. So those types of projects, though expensive, can be written off currently as a repair or recurring maintenance.
So what would be the advantage of writing it off? So let's say that it would qualify for bonus depreciation. Would there be a benefit to writing it off entirely in the year as opposed to according to the depreciation schedule, but using the bonus depreciation? What I'm getting at is
right.
One would be subject to potentially recapture on sale, the other would not.
Exactly. Really, there's two benefits. Number one, you nailed it already. Bonus depreciation for certain types of assets needs to be recaptured, specifically Section 1245. So that's like personal property. When that property is sold, you're going to need to recapture that bonus.
Or at least the undepreciated component of the bonus.
Undepreciated part.
Right.
The other advantage, which several of our clients deal with, they're so used to getting all this bonus depreciation to offset their federal tax bill, but then they file, their state taxes and they realize they don't, they have to add that all back. States generally don't conform with federal bonus depreciation. So if you write off those improvements correctly and currently as repairs or maintenance, you don't need to add that back for state taxes. Your federal and state taxable losses from those will be aligned.
I love that. And so where do you think the mistake, I would imagine most CPAs would be attuned to that notion. Why are so many people missing it?
I think it's really just the dollar amounts. A CPA not having a good understanding of how these buildings are constructed and what types of projects need to be done to maintain those buildings. One of the most common and beneficial projects we see that are incorrectly depreciated are on industrial buildings or commercial property where you have like an overlay on top of the roof, a rubber membrane or something that covers the roof and keeps the building watertight. It's super expensive to replace those, but they do need to be replaced usually in less than 10 years. And even though it might cost $500,000 to do that on like a couple 100,000 square foot industrial building, that's really just general maintenance for the building. It's not a capital improvement. It's not a betterment, a restoration, or an adaptation of that property. So I think if CPAs get a little more familiar with the engineering and how these buildings are constructed, it's easier to pick out these things.
So presumably there is a gray zone and presumably a bunch of case law that determines where in that gray zone things fall. I'm sure the IRS wants their money. And are there specific cases that you point to, that you look at to say, well, no, this falls under this category of repair and maintenance and is not an improvement?
Well, really, in our experience, this isn't an error. And speaking with the IRS, and we know a lot of people that have worked at the IRS, currently work at the IRS, they don't really focus on recapturing tax dollars from issues involving bonus depreciation or write-offs of capital improvements. They're not looking at recategorizing these projects because in their eyes, it's really just a deferral of taxes anyways. They don't think about the time value of money that is involved with writing off something completely now or over the course of 27 and a half years. It's just a tax difference for them. So, I mean, quite honestly, with our perspective from audits that we've worked on, speaking with IRS and state tax, DOR professionals, casually, this isn't usually an area that they're very concerned with. The IRS is so strapped with their resources right now. They have a much more narrow focus, and the tax law is very favorable to people writing off improvements right now. It's just not an area that they concern themselves with greatly.
One area where there's often, I'll say, a shorter lifespan, more shorter and shorter every day, it seems, is appliances. Appliances that used to last 15, 20 years, sometimes today only last 5. Where would those fit? Do those fall in that repair and maintenance category as well? If they are, let's say, 5-year, if they were originally depreciated, let's say over 5 years, and now they are quote unquote fully consumed, is the replacement also a capital expenditure, or could that be expense as well?
I think with the dollar amounts with those, I wouldn't worry about taking a more aggressive position, but I think on the returns that we file, we would typically just bonus depreciate those or take a Section 179 expense, which is kind of like bonus depreciation's, twin brother. That is a little better because you can, most states do allow you to claim Section 179. The other thing with appliances, not a high dollar amount. A lot of the appliances that are going to be installed at an apartment building, for example, would fall under the $2,500 threshold the IRS has to immediately expense those. So under the tangible property regs, any line item expense that you have for a property, whether it could be treated as capital or not, can be written off if it's $2,500 or less. If you have audited financials, they increase that threshold to $5,000 or less. So if I bought a 60-unit apartment complex and put in a brand new dishwasher that cost $800 a piece in every unit, I could write all those off currently without worrying about how the IRS would treat it as improvement or not.
I love it. Well, Eric, this has been a fascinating conversation. If folks want to connect, if they want to learn more, what's the best way?
Sure. Our website is scaffidibrunner.com. My email address is eric@scaffidibrunner.com, and feel free to reach out to me directly or through our website. And, we'd appreciate the opportunity to work with you.
Fantastic. Well, Eric, great to connect. And for the listeners at home, you definitely want to connect with Eric Brunner at scaffidibrunner.com. The links will be in the show notes. And in the meantime, have an awesome rest of your weekend. Go make some great things happen. We'll talk to you again tomorrow.